This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, we're looking at chapter 13 of the free lecture notes for paper F9, which is headed at capital structure and financial ratios. And what basically we're looking at in this chapter, we've looked at in previous chapters about ways of raising equity finance and ways of raising long-term debt finance. But of course, a business normally has the choice. And if you've got a business that needs to raise, I don't know, 100,000, which would be better? Would it be better to raise it from equity, or would it be better to raise it from debt? And that's what we mean by capital structure. Now, there's a lot of theory relating to this that comes in a later chapter, but essentially, as far as debt finance is concerned, the attraction of debt finance, the reason a business might prefer debt finance as against equity finance, is that it's going to be cheaper, almost without question. And it's cheaper for two reasons. One reason is that as far as the lenders are concerned, lending debt is less risky than investing in shares. If you invest in shares, there is a risk, because you're not certain what the dividends are going to be. You know, in future, the dividends may be very good, they may be very bad. That's the risk that you're taking. However, with debt finance, of course, you're getting fixed interest each year. In that sense, it's less risky. And if it's less risky, investors are likely to require a lower return. So one reason is it's less risky to investors. Now, the other reason is, of course, you should be aware from earlier exams that if we raise debt finance, okay, we're paying interest, but the interest is allowable for tax. The tax is calculated on the profits after interest, so the more interest a business is paying, the more tax they'll save as a result. Whereas dividends, of course, aren't allowable for tax. So interest is tax allowable. So if, for example, you're having to pay interest at 10%, it will reduce the taxable profits. And if tax is, let's say, 30%, then you pay interest at 10, but you save tax. 30% of 10, 3%, the net cost is going to be lower. So those are the attractions of raising debt finance. However, the downside is that more debt finance, or more debt, means more risk to the shareholders. And this is the first thing I want to illustrate in this lecture as to why it makes things more risky for the shareholders. But if for just one moment you accept that is the case, surely if we're acting in the benefit of shareholders, there is that problem that, okay, debt finance may be cheap money, but it makes shareholders, their investment, more risky. And the level of debt finance we call financial gearing. And to explain why it creates more risk for the shareholders, look at example 1 on the second page. You've got two companies, U and G. They're both generating operating profits before interest of $100. So in that sense, they're identical companies. They're both generating the same profits. U is an ungeared company. And ungeared means there's no debt finance, so all the finance is coming from equity. G is a geared company. Geared means there is debt finance involved, and they have to pay debt interest of $30 a year. Taxes payable at 30%, and suppose both companies distribute all their earnings as dividends. That's not a requirement, but it just keeps the illustration relatively simple. This is only an illustration. And so look as things are at the moment. U and G, they both make profits of 100. U, there's no debt finance, so there's no interest payable. Therefore, the tax 30% of 100 is 30. And there's 70 available to give to the shareholders. Company G, the geared company, same profits, but they're operating profits, but they're paying interest of 30. Profit before tax is 70, tax 30%, 21. So they're paying 49 to the shareholders. And okay, shareholders in G are getting less money, only 49, but that's not a problem because appreciate, if some of their finance is coming from debt, shareholders have had to put less money in, and so no problem, they're getting a lower dividend. But more importantly, it says calculate the change in dividends that will result if profits were to fall by 20%. If profits fell by 20%, U and G, the profits, they were 100, but if next year they fall by 20%, they fall to 20%, 20, they fall to 80. The debt interest, well, U has no debt borrowing, so no interest. G, they've still got to pay their interest of 30 a year. And so the profit before tax, 80 and 50. The tax at 30%, 24 and 15. And therefore, the dividends they can pay, it says they're distributing all their earnings here as dividend. Obviously, in both cases, it's lower. In the case of U, it's what? 56? In the case of G, it's 35. Now, fine, if profits fall, obviously, the amount available for dividend falls. But in percentage terms, in the case of U, the dividend was 70, it's fallen to 56, so it's fallen by the difference of 14. As a percent of the current 70, in percentage terms, it's fallen by 14 on 70, which is 20%. Hardly surprising, profits are down 20%, dividends down 20%. But look at G. G was paying 49, it's now fallen to 35, so again it's fallen by 14. In percentage terms, currently 49, it's fallen by 14 on 49, which as a percentage is what? 28.6%. Now think about that for a moment. You see, in any company, profits stand to fluctuate. Clearly, that's a risk in any company, that you're never certain what the profits are going to be. But the geared company, because they still have to pay the fixed interest, profits fall, but they still have to pay that fixed interest of 30. The effect on the dividends is greater. A 20% fall in profits. With a geared company, here it's resulting in a 28.6% fall in the dividend. And of course it works both ways, although it's not asked here. Well, sorry, let's do part B, I beg your pardon first. Suppose profits fall by 40%. The profits, they were 100, fall by 40%, they fall to 60. Debt interest, U doesn't pay any, G pays 30. So profits before tax, 60 and 30. The tax at 30%, 18, 9. And so the dividend they can afford to pay, 42 and 21. Well, again, what's the percentage fall in dividend? Currently, a dividend of 70, profits fall by 42, 242, sorry, so they fall by, 28 on a current 70. And so this time, 28 on 70, again. If profits fall by 40, the ungeared company dividends fall by 40%. But what about the geared company? Their dividend, at the moment, back to the question, is 49. It falls to 21. So again, a fall of 28. But in percentage terms, 28 on a current 49. 28 divided by 49. It's fallen by 57.1%. And so again, the risk exists because you're never certain of your profits. If we were certain of the profits, if the profits were guaranteed to be 100 each year, then in both companies, the amount available for shareholders would be fixed. It would be guaranteed there'd be zero risk. But because the profits themselves are always risky, you're not certain that they will stay at 100. They may be higher, they may be lower. Because there's risk attached to the profits, the effect of gearing is that because of the fixed interest payable each year, the more gearing, the more fixed interest, the more the dividends are going to fluctuate. Now, I started to say before, it works both ways. Let's just do one more. Suppose for the same question, currently profits are 100. Suppose profits increase by, let's say, 30%. Well, what's going to happen? They're currently 100. So in both cases, the operating profits go up to 130. Again, interest, U pays no interest, G pays a fixed 30 a year. So profits before tax, 130 and 100. Tax at 30%, for U is 39, for G is 30. Leaving an amount available for dividend of 91 in the case of U and 70 in the case of G. Again, obviously if profits go up in both cases, the amount available for dividend goes up, but the percentage increase in the dividend, in the case of U, it's gone up from 70 to 91. From a current 70, so in percentage terms, gone up 21 on 70, which is 30%. No gearing, so as profits go up and down, dividends go up and down by the same percent. But in the case of G, it was 49, the dividend. It's gone up to 70, so again, it's gone up by 21. But currently they were getting 49, so in percentage terms, it's gone up by 21 on 49, 43%. So that's what I mean when it works both ways. Profits fluctuate. They may get higher, they may get lower, there is risk. The more gearing there is in a company, the more fixed interest is payable. And so, the greater the fluctuations in the dividend. And okay, if profits are going up, great. Gearing's terribly attractive. If profits go up, in percentage terms, the dividends go up even more. But of course, the risk is if profits fall, again, because there's still the fixed interest payable, if profits fall, dividends fall by an even greater amount. You see, risk isn't always bad, if you understand me, you know. Profits themselves may be higher, great. They may be lower, a problem. That's what the risk is. But they're not certain. It may be better, it may be worse. But the effect of gearing is to increase the risk. It increases the existing risk because of that fixed interest. And the more gearing, the more fixed interest, the more it makes things risky for the shareholders. You'll see below the example measures of gearing. How do we measure how much gearing? Well, there are two ways it can be defined. And in the exam, the examiner will either tell, almost always, he tells you how he defines gearing. If he doesn't, then either way will do. But it's either the debt borrowing divided by the total equity, share capital and reserves, or, and I'm going to illustrate in the next example, it's debt borrowing as a percentage of the total long-term capital, debt plus equity. But you will see in those formulae, preference shares, I think I mentioned in the last chapter, preference shares are effectively the same as debt because they are fixed interest. It has the same effect. Let me show you what I mean. Can you look at example 2, please? You've got a simple statement of financial position there. Assets 250,000 in total. It's finance, share capital 10, reserves 130. So the total equity finance on the statement is 140,000. Debentures, long-term finance, non-current liabilities 100,000. So the total long-term finance is 240. We're told below the market values of the shares, of the debentures, and it wants us to calculate the gearing ratio using A, book values. By book values, we mean the values on the statement of financial position. So the two different ways of measuring it, it's either measured, if you check back to before, the debt, which is 100,000, divided by the equity, the share capital and reserves, and according to the statement of financial position, the total money from shareholders is 140, which gives us 0.71, or if you prefer 71%, it can be expressed either way. So that's a measure of how much debt there is relative to the amount of equity. The alternative, it'll give a different figure, but the two standard ways of measuring it is to take the debt, 100, divided by the total long-term finance. So from shareholders 140, from debt 100. So on this measure, 100 divided by 240 is 0.42 or 42%. Now obviously we can't compare the two, it's one or the other. And as I said, the examiner makes it clear how he, in an individual question, how he wants it measured. But I think you'd agree in both cases, the more debt there is, the more gearing there is. In both cases, the higher the gearing ratio would be. And remember, there's two sides to it. It's not a question of saying, oh, that's good gearing or bad gearing. higher gearing, more debt. It is cheaper money. The interest gets tax relief. But the downside, as you said, I hope you were clear from the previous example, the downside is that the more gearing, the more risk there is to shareholders. Great if profits are going up, worrying if profits are going down. Now that was the gearing calculated on book values. However, in some ways it's very misleading because the book values, the values in the statement of financial position, aren't in a sense true values. You know, the assets, non-current assets 200, again, it's purely a book value. The actual assets may be worth a lot more or a lot less. A far better measure of the gearing is to use the market values. The values of debt and equity on the stock exchange. And what are the values? Well, the equity, he says the 220 a share. Now be careful here, because how many shares are there? If you look at the statement of financial position, the nominal value is 10 cents. The total nominal value on the statement is 10,000. And so surely at 10 cents a share, there are 100,000 shares in issue. The market value per share is $2.20. And so the total market value of the equity is 220,000. What about the market value of the debt? Again, the figure on the statement of financial position will be the nominal value, 100,000. But the debentures have a market value of 95%, so 95 for every 100 nominal value. And so the market value is what? 95,000. As far as the gearing ratios are concerned, and it's here to be careful of one silly mistake people make. I'll do it the two ways again. First of all, if we measure it as just debt divided by equity, debt is 95,000. On market value, equity is 220,000. Which comes to 0.43 or 43%, which of course is a lot different than it was before. But before I do it the alternative way, firstly, to use market values is a better measure of gearing. In the exam you do what you're told based on what information you're given. But it is a better measure because market values are, if you like, the true level of debt and equity borrowing. But the other point, quite importantly, a lot of people say, oh, all right, we're using market values. Should we not take the market value of the equity and add on the reserves of 130? Well, the answer is no. That clearly when we're using statement of financial position values, there's no question, 10, 130, 140. However, market values, effectively, the market value already includes the reserves. You know, the most obvious reason why the market value is higher than the nominal value of 10,000, the most obvious reason is because the company has been retaining earnings. It's the most obvious reason of all why the market value is higher. That 220 effectively includes the retained earnings, the reserves. So we don't add it on again. The alternative measure, well, that should be no problem. Debt as a ratio of total long-term borrowing, equity plus debt. 95 divided by 315.30 or 30%. So there we are. I mean, it's easy arithmetic. As I've already said, it'll be clear in the exam which of the two ways of measuring it you're expected to do. And it'll be clear in the exam whether he wants you to calculate it based on book values or on market values. So there's no problem, it's just reading carefully. But as I've said, basing it on market values is actually what you might call more realistic. And basing it on statement of financial position values will usually overestimate the gearing, because the book value of equity doesn't have to be, but is almost always going to be less than the market value of equity. And so as you can see here, when we did it based on book values, we got much higher figures. It overestimates the actual effect of the gearing. All right, I'll leave this lecture here. In the next lecture on this chapter, though, I want to mention something called operating gearing, which isn't directly to do with how we raise finance, but as you'll see, having discussed financial gearing, which is what that was, it does make sense to discuss operating gearing in the same chapter, but we'll do that in the next lecture.